Well, it was interesting. This is to see what's coming out in 2025. One of your funds is Evergreen. That hasn't been your approach in the past. Your funds have been, you collect the money and invest in the assets, and then, in a few years, sell the assets and return the money to the investors. Tell us a little bit about the decision to add an Evergreen fund, as well as what you see as the upsides and downsides of Evergreen and non-Evergreen funds.
Yeah, we did a survey of our investors, and we had a number of investors say they wish they had liquidity. In fact, some of our investors have invested in some of our short-term sidecar deals, and we realized there really is a demand there. People want that little bit of control. They don't have much control in a passive investment, but they really like liquidity. And the way to do that was to offer an evergreen fund. We also have people who have a Warren Buffett mindset who said, my ideal holding time is forever. And they really like that longer term strategy. So we decided to put together an evergreen fund to allow our investors to have that liquidity, to have a shorter term if they want it, or a longer term hold. It gives them that flexibility.
Yeah. What are the downsides, though? I mean, who wouldn't want liquidity if there was no cost to it, right? What are the downsides to the investors in the fund? I mean, there's got to be a little bit of cash
Yeah.
to meet those redemptions, right? So there's some cash drag. And
Yeah.
does it limit what investments you feel like you can put into the fund? Because, if everyone decides they want to exercise their liquidity and not wait the time it takes for that investment to pay
Yeah.
off.
Yeah, there are limitations on it. We have the right to refuse if there is a mad run on the bank, if you will. Just like every fund has the ability to say no. Um, but I think one of the downsides is the investors typically don't get the proportional appreciation if they pull out early, because it's really hard to know. Those assets I showed you on the full cycle track record. Though you really can't see that those returns are going to be what they are until about the time they sell. And so if someone pulls out 4 years into a 7-year deal, they're probably going to get shortchanged on that growth.
Does it hurt the other investors in the fund, though, to have to meet that person's need for liquidity?
The reason I don't think so is we always plan to be raising money. And so if somebody, says on January 10th that they want out on, April 10th, 90 days, it's pretty likely if that's a $100,000 investor that we'll have another $100,000 come in that month. We raise millions a month, in fact. And so I don't think it should.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.